Why haven't transaction volumes kicked in, if you will, in 24 like projected?
The buyers are there. People want to buy. My company wants to buy. Everybody wants to buy, but there's just not a lot of sellers. And I think a lot of it stems from the fact that we're not seeing the distress, kind of forced sales that everybody expected to see so far this year. And because of that, we're seeing a lot of, we've actually seen downward pressure on cap rates, as you know. And, it's a seller's market. And so it's tough there's more buyers than sellers. So it's tough to make things happen unless you're willing to push into some cases, mid-4s.
Prominent CEOs, leading economists, iconic investors. Insights from the experts. The Walker Webcast with Willy Walker. See who's next.
Welcome to another Walker Webcast. It is my pleasure, honor to have my friend Jay Parsons here with me today in our Zoom room in Denver to talk about all of the great data and research that Jay pulls together, manages, deciphers, and puts forth to his partners at Madera Residential. Jay, it's great to have you here. Thanks for coming in.
Thanks for having me, Willy. I'm excited to be here.
It's really great. A quick background on you, Jay. You were chief economist at RealPage before going to Madera. You graduated from the University of Maryland. You're a terp, turtle, which is great, close to my heart.
Yep, fear the turtle.
Father of 5, so you've got your hands full at home.
Yes, sir.
And a suffering Dallas Cowboys fan, which as a Skins Commanders fan, I have to tell you, of all the things that I want to feel sorry for you about, as my colleagues in Dallas know, I grew up with the Redskins competing with the Cowboys, and have always loved that rivalry. So you all suffering.
You're having a good year right now.
We are, except as you know, 2 losses in a row, but I think potentially against the 2 best teams in the NFL. So we'll see how they go. Jay, let's start here. I want to. After NMHC at the beginning of this year, you came back from NMHC and you said, a good conference. Here are my takeaways about what 2024 might look like. And so first was, you said, optimism is back in the market. So let's put up this first slide that we have, which shows apartment sales volumes falling to their lowest levels in the past 10 years. That's sort of the flip side of it, in the sense that the optimism that we saw at the beginning of the year would have led you to believe that we were going to see a huge boom in activity as it relates to trading.
Yeah.
Other than the general sentiment that has been that optimism is back in the market, transaction volumes wouldn't tell you that that's there. Why haven't transaction volumes kicked in, if you will, in 24 like projected?
Well, I mean, it's a great question. That's definitely been the biggest, I think, miss for me and a lot of us this year. That, and I think that very high retention rates we've seen, which is a different topic. But I think a couple of things. Number one, as you know, the buyers are there. People want to buy. My company wants to buy. Everybody wants to buy, but there's just not a lot of sellers. And I think a lot of it stems from the fact that we're not seeing the distress, kind of forced sales that everybody expected to see so far this year. And because of that, we're seeing a lot of, we've actually seen downward pressure on cap rates, as you know. And, it's a seller's market. And so it's tough there's more buyers than sellers. So it's tough to make things happen unless you're willing to push into some cases, mid-4s.
And what do you think makes that price capitulation happen? In other words, you had Paul Thrift on your podcast last week. We just sold an asset for Paul in just south of Denver last week at a 4.5 cap.
Yeah.
Great sale on his part. But what's your sense as it relates to what's holding back transactions and what makes it flip? Because clearly one would sit there and say, well, once we get back to positive leverage, people can start to actually transact. But we saw cap rates slowly move up, but now all of a sudden we've seen borrowing costs start to kind of catch up with cap rates. And so we were for a quick instant in Q3 with significant margin for positive leverage. On a lot of deals we're right now, both selling and financing, we're back at either equilibrium or potentially negative leverage. Yeah. So rates stay high. Do transaction volumes stay low, even though there's this big pent-up demand for product?
I still think eventually we're going to have to see sales volumes pick up. I mean, there's so much appetite for housing, both multifamily and for SFR, BTR. I think we're seeing more buyers. We've seen some institutional players say, hey, we're going to accept a pretty weak year one in the pro forma because we believe in the mid and long-term story for multifamily. So I think you're going to see more capital start to move that direction, particularly now. The other thing that happened, by the way, as you know, was earlier in the year, everyone thought we'd see rate cuts earlier than we did. And that didn't happen until much later in the year than people first thought. So now that's started to happen a little bit. The Treasury is still a little bit sticky, but I think as that happens, supply goes down. We still see great demand in the market. The fundamental story is there. I'm still pretty bullish on the overall direction. Second part of that is I think a lot of the reason volumes are so low is because the value add guys are out of the market completely right now. So a lot of the short term, kind of buy, fix, flip, that's completely gone. And we've not really seen, the Class A market, the stuff, the merchant builds, a lot of that's kind of settling in the mid-high fours. We don't know where this kind of busted Class C value add stuff's going to go. I think that still has to play out. And where, at what point that has to be pushed into the market, I think that'll be a big story next year as well.
Start a legacy. Start turning dreams into realities. A better world begins with you. Better communities start with us.
You mentioned rates. You want to give your outlook
Not
on
really.
where they take exactly. I mean, it's so interesting because Fed comes out with their 50 basis point cut, and all we've seen is the rates go up subsequently.
Yep.
Clearly, people were sitting around saying it's sort of the fear about tariffs and what might happen on the tariffs front. You also have, and plenty of people doing reports as it relates to the inflationary pressures that would come from the broad across the board tariffs that President-elect Trump has talked about.
Right.
There are plenty of people who sit there and say that was just rhetoric during the campaign and he won't implement all of them. But there was a really interesting, I think it was B of A research report that CNBC put a slide up on last week, which showed those products that had been impacted by Trump's first term tariffs and those that hadn't, and what happened in the CPI. And clearly those that had been impacted by the tariffs, cost went up, and those that hadn't went down. And so it's hard to think that we're going to get away, if you will, with any kind of broad-based tariffs and not have that be inflationary.
Right.
And at the same time, there's also this general outlook that the economy picks up, continues to grow at a high rate. What's your take as it relates? I mean, should the 10-year stay in this 4 to 450 range? Do you think that it's a 450 to 5 range? Do you think that there's something that says that it comes down materially because China is weak?
But first of all, I think that the two things that make every forecaster look foolish are oil prices and interest rates. So take everything with a grain of salt here.
Yeah.
But I still think we're going to see it come down. And the reason is, the Fed is supposed to be immune to political pressure. They're people. And there's so much pressure right now related to mortgage rates. We're a country where still American dream is home ownership. We want to keep 2/3 of American households as homeowners. I think that there's going to be enough pressure to reduce rates, so we see people buying homes again, that will continue to cut rates a little bit. So I don't think we're going to get back to where we were before. I don't think anybody thinks that. But I'm still glass half full, thinking that we're going to get back below 4 at some point.
I so hope you're right. One of the other things in your post-NMHC analysis last year was sort of the heads on bed strategy.
Yeah.
How operators would try and maintain occupancy levels even as rents went flat. And so we have a slide that shows this out, Jay. Talk for a moment about that strategy and how that's played out for operators this year.
Sure. Well, I mentioned there's a couple. I was very bullish on demand going into this year, the front door demand, and that's proved out to be true. The backdoor story, I think, has been a really interesting surprise. In fact, Joe Fisher at UDR mentioned the same thing and kind of the surprise of retention this year. We have 50-year high in apartment supply. People have more options than ever, and yet retention rates keep going up. People are staying place. And so the instant kind of gut reaction is people say, well, the move-outs to purchase are at low levels. That's why. Well, move-outs to purchase, even in boom years, are less than 20% of move-outs for apartments. So that's only a part of the story. Most moves are for more normal things. People moving, relocating, different apartment, different city, whatever. So I think a lot of what's happened is what you mentioned. It's heads on bed strategy. Going into this year, everybody knew that retention would be an issue. You knew you're competing for these new leases, all this supply. You knew that you had, other companies are trying to get your renters out. They're offering concessions, lure them away. And so I think there was a very purposeful strategy throughout the industry to say, hey, look, we got to get back to the basics. Occupancy is always important, but especially right now, we got to protect that back door. Your demand is not just the front door, it's also the back door. And so we've seen, and I've talked to property managers throughout the country that have really prioritized doing all the little things, not just the renewal pricing, but if you put them, if you're sending out your renewal 30, 60, 90 days, whatever it is in advance, and it's a manageable number, and that tenant, that resident is having a good experience, they're more likely just to renew and not shop around. And so I think that strategy, there's a lot of other factors, but I think that heads on bed strategy throughout the industry has really paid off.
I guess the question I'd have there is, first of all, mobility. Mm-hmm. Clearly the September jobs number of 285,000 jobs scared a lot of people. And one of the reasons why we've seen rates go up so much is that people thought that the Fed was going to have to slow it down. But I was at a real estate roundtable meeting last week with the head of the Richmond Fed. And he was talking about the fact that right now they're seeing about 100,000 monthly job ads, but that he watches the firing rate, and the firing rate is at almost a 25-year low. And so what you're getting right now is, the 100,000 jobs per month is looking back to like 2014 as far as a corollary, and that's not robust job growth by any measure. And yet at the same time, with almost a quarter century low firing rate, sort of employers are standing still, and therefore employees are standing still, therefore not moving from Charlotte to San Francisco and staying put, which then gets you into that renewal strategy. But then talk about the amount of supply, because you're very straightforward. We got a slide in here that shows the dramatic amount of new supply that's come on. We've delivered more units through Q3 in 2024 than we have since 1987, I believe is the stat that you put out there. Yeah. So when someone's sitting there in the market they're staying in, and there's all this new supply, why is it that people are able to get renewals at 3 to 5% growth rather than someone moving across the street to the brand new apartment building?
Well, I think, candidly, I think some renters are not choosing the smartest financial decision. They're choosing what's the easiest decision, and the friction of moving is outweighing the what's really a relatively small financial benefit of moving in terms of a lower rent. Now, those who are moving, a lot of times they're getting a similar rate and a newer, better, higher amenitized property for a pretty good rent. So we're seeing that demand moving up market, but you're still preserving a pretty good portion of your renter base as well. So the supply is an incredible story. I mean, we are, as you mentioned, 9 months into the year, highest number since '87. We're going to finish the year the highest number since the 1970s, mid '70s. So the fact that we're seeing this much supply and yet still seeing demand that's not fully on par with supply, but we're going to have the second best year for absorption since other than 2021, going back 3+ decades. It's a really remarkable story. That just speaks to the resiliency of this sector.
Does it also speak to the cost of housing being completely sort of economic for someone making the median income in America, and therefore, that gap between what it costs to rent and the cost to own right now, given where rates are and given supply on single family side, is such a big bridge. But you said the move out is only 20% of the market on a typical basis?
Yeah, of the move outs. Yeah. So, and that's for the high end. So it's definitely a factor, but I look at it too, in that the best years for the apartment market were great years for the home sale market. 2021, record year absorption, great year for the home sale market. And so ultimately, I have a little bit of a contrarian view on this. I think that long term, we need to see the for sale housing market get healthier again, or to sustain the type of rental demand we're seeing because of the impact of that home sales have on the broader market in terms of you buying homes and all the impact to the consumer spending, going to Home Depot and Lowe's and doing stuff, hiring contractors and everything else that happens downstream that boosts apartment demand. So I think it's a part of the story on retention side, but again, long term, I tell people all the time, I think every rental housing investor in America should be rooting for a stronger for sale housing market long term.
It's interesting because I had Ryan Marshall, the CEO of Pulte, on last week, and when I sort of dove into exactly what you just talked about, and I talked about undersupply on multifamily and the next kind of 3-year outlook, what was interesting to me was Pulte is going to build 29,800 homes this year. And I sort of pushed him on, is that going up to 1.5 times that number? You're going to be building 40,000+ homes like they were in the 2003, 2004. And he was like, no. I mean, right now, there's no desire on their part to try and raise their output and get back to sort of a business model that they were in the early 2000s, which was grow, share, and produce a lot. And we actually put up a slide during that conversation, which was talking about how incredibly they've done on slowing down their growth as far as units, but then continuing to increase their margins.
Right.
One of the things that you talked about in your outlook after NMHC was that expenses will outstrip revenue growth in multifamily. Have we seen that this year? Because one of the things that Ryan did say that I thought was very interesting was that their costs of manufacturing on the single family side are down in the low single digits. So the inflationary pressures that were very much in the single family space in 2022 and 2023 are gone, except their land cost is still in low double digits. And that's the only thing that's really pushing their costs up right now. Talk about multifamily and that sort of rent growth versus cost growth. Piece.
Well, on the operating side, it's been interesting because obviously rent growth preceded some of the massive expense growth we saw. Obviously, apartment operators, as you well know, it's property taxes, it's insurance, but also payroll has gone way up. When you're in a down market, marketing costs go way up. And so that has moderated this year. We've seen, after insurance skyrocketed in some cases 50+%, 100% of the last few years, it's been flatter for most investors this year. Property taxes have come in a little more favorable. But even, that said, a lot of owners right now are happy with the moderation of expenses. To your point, like in a lot of markets, expenses are still growing faster than revenues just because in a lot of markets, new lease rents are negative. There's occupancy pressure. And so I would say it's probably not quite as bad as people thought it would be going into this year, just because of the strength of the demand and also the strong retention I mentioned earlier and being able to still get 3-4% renewal trade out. But it's still tough, right? It's everyone's trying to figure out everything they can do to save on the expense side, and there's been a lot of creative strategies to do it, just to protect NOI as much as they can.
One of the things on that I thought was kind of interesting, Jay, is that if you look at the home builders, there's been massive consolidation into the public home builders, and you look at your comment as it relates to the management of multifamily, and I would think that the increased institutionalization of both, if you will, that multifamily institutionalization will mirror what's happened in the home builder space in the sense of economies of scale, very professionalized management practices, and sort of driving costs out of the system. Do you agree with that, or do you think that sort of the middle market operator has a future of being able to compete with the big behemoths?
Yeah, that's a great question. I think obviously we're seeing some of that. I think we'll see more of it. I think the bigger impact is going to be on the development side. And so you mentioned on the home builder side, there's been, in fact, one other person I talked to recently was Hugh Frater, and he made the point that there was so much consolidation among home builders. We have not seen that yet on the apartment developer side. Right. But talked to Paul Thrift, another big builder. With JPI, Peyton Mays made the same point, is obviously these are larger top 20 NMHC top 20 developers, and they see an opportunity to really become bigger, relatively speaking, in the market because they can command more efficiencies of scale. They could take the same materials and take the same crews and start kind of copying and pasting in different markets, different locations, much easier than a smaller builder. So just like in the home builder space where we saw so much consolidation, I think that there's going to be a lot of pressure on apartment development. Is highly fragmented. I'm going to get the exact stat wrong, but it's something like the top 25 developers in the U.S. are something like less than 20% of starts in 2022. It's going to go way up in terms of the big players and what share they have because they're able to buy and build much more efficiently, using now technology to find cost savings as well. We're seeing a lot of just very creative things that your average local builder who builds a few projects a year, they're not going to be able to do. So I think that's where we're going to see just a lot of consolidation.
It's interesting to think about that in the sense of secured and unsecured financing, and then also the role that the banks play. Because like if you look at single family and multifamily, neither Fannie nor Freddie play in the construction space. So there's not a difference between the two markets on that. And yet at the same time, in the single family space, you have clearly seen massive consolidation into the big home builders. As you just said, you haven't seen it in multifamily. But then you think about secured versus unsecured borrowers. And in the multifamily space, the large REITs right now are generally speaking doing unsecured borrowing off their balance sheet, which given where bond financing has been good, but not great vis-a-vis the agencies. It's just interesting to think about the future of the agencies, their role as it relates to secured financing versus unsecured, and whether there's something there from a cost of capital standpoint that would allow some of these major REITs, whether on the construction side or on the hold side, to better compete with those who are going out to do secured individual financing with the agencies.
Yeah, I mean, you just touched on so many big things I think are going to be happening. Is number one, on the REIT side, just going through the recent earnings calls I just went through, almost all of them know they have a unique opportunity right now to be building when others can't because of their lower cost of capital.
Right. And
so we're seeing Avalon Bay, MAA, et cetera. I mean, they're looking, they are starting projects. Avalon Bay is building in Austin in a time when no one wants to build in Austin, but they see a long-term opportunity there. On the other side of that, you mentioned the agencies. Well, there's a lot of movement right now kind of beneath the surface a little bit to create some sort of national construction fund that's backed by the agencies that would then kind of lower the cost of capital for other developers to build, where there's some sort of guaranteed exit to Fannie or Freddie after that project reaches stabilization, which takes out the lease-up risk. So I think that's probably something where we're going to see some bipartisan interest to eventually kind of bridge that gap, whether it's directly injecting the agencies into construction lending or having some sort of agency-backed construction fund that they are tied into. So that could be a real game changer.
I was going to hold off on talking about the implications of the election, which you did a lot of work on pre-election of sort of like, this is what a Harris presidency or a Trump presidency would mean. And I want to talk about that in a moment. But while we're on the agencies, let's just double click on that for a moment. You think they get spun?
Some people thought they get spun the first Trump administration. They didn't happen. I hate to just put out the typical economist maybe, but I'd put it at 50-50. I think there's a real chance of it, but I don't know if it's a top priority. It's going to take a lot of, I think, willpower to make it happen, and I don't know if that's going to be a priority.
Yeah.
I know a lot of people are rooting for it, though.
Well, I think there are plenty of people who are quote unquote rooting for it. I think it's also, if you think about, there are a lot of variables there, as you well know. Yeah. Mark Calabria, who was FHFA director in the last Trump administration, would tell you that they were on their path to doing it had the pandemic not hit. He and Mnuchin were, well down that path. Whether Mark goes back to FHFA or whether he goes to Treasury to be the counterpart to whomever is in FHFA to work on it is a real question. Yeah. And then I guess the other piece to it, which is one of the few cabinet positions that has not been announced yet, is who is the Treasury Secretary, because whomever goes into that role will obviously have a big voice in whether it's let's do it through administrative action, or let's go take the legislative route. And then clearly you look up to the Hill and whether French Hill becomes the head of the House Financial Services Committee, Tim Scott is going to be the head of the Banking Committee. Those would be the two people in the Senate, House and the Senate respectively, who would focus on a legislative solution. But the other piece to it, as you probably know, Jay, is that there's nothing in the legislation that says that it has to go through a legislative reform. In other words, they don't need a vote of Congress to spin them back out. Yeah. And then there's also that discussion about borrowing cost and the fact that borrowing costs will go up by 5 or 10 basis points because they would have a implicit government guarantee rather than an explicit government guarantee. And I talked to Calabria about this issue a couple of weeks ago, and Calabria said to me, the issue with it, Willy, is that there actually isn't an explicit guarantee on them now that they're in conservatorship. The market thinks that because they're in conservatorship, there's an explicit guarantee. But there's nothing in the enabling legislation of HERA which says that there's an explicit government guarantee. So Mark's point was, if they got spun, that 5 to 10 basis point that lots of people sort of are trying to some degree fear the market into may not materialize. So it was an interesting discussion about what might happen. I think the other piece to multifamily that we have to be conscious of is if you look back to when Ed DeMarco put caps on the multifamily volumes, that was, I think, done to say, hey, private capital should have a place in this market. And we don't want private capital in the multifamily space to turn into private capital in the single family space. Because you've got 80% market share of Fannie and Freddie in the single family space, and you got 40% market share in the multifamily space. The big question that I have is, let's just say that they get spun in a way that's just to spin them back out and bring in private capital. What's the regulatory overlay, if you will, as it relates to the role they're supposed to play in the multifamily space? And do they keep the caps on them? Do they pull the caps back? Do they allow them to get into construction lending, as you pointed out, or not? There just seem to be a whole lot of question marks about that. But I'm interested in your 50-50.
Well, I actually think you can make a case that they could better achieve their mandate long term by being spun out. And that might be a controversial statement, but I say that because we are on a path prior to the election of seeing more regulatory scope creep through Fannie and Freddie debt. So, we saw a movement to attach certain, it started off pretty basic. I mean, things like notice periods for renewals, but there was a big push, as you probably know, among tenant rights advocates to attach rent control to Fannie and Freddie debt. And I think eventually we probably would have seen some version of that for some type of, it would look like something. I don't know what, right? And that would have pushed more, I think, borrowing to the private market as well. So I think now that obviously elections, we don't know what's coming 4 years from now, so there's still a lot of things. But if it's spun out, I think that does in some way sort of protect Fannie and Freddie from further politicalization of its real mandate, which is keeping liquidity in the sector.
Yeah. I concur on that one wholeheartedly. One of the other themes to this year, Jay, which you rightfully pointed out back in February, but was quite sort of at that time kind of a counter to what people were expecting, which was limited distress in 2024.
Yeah.
Why is it, from your analysis, that we've had such limited distress in the multifamily space in 24?
Well, so this is a topic that's been really interesting because I'll give you an example. So this summer, there was a big headline in the Wall Street Journal, and it was all about distress in commercial real estate, office and multifamily in the same sentence. And a lot of it was using debt funds and CMBS data to tell a story about rising distress. Well, to the average layperson, it looks like, wow, these are big numbers. It was like $80-something billion of potential distress. Well, what they left out is there's $2.3 trillion worth of multifamily debt.
And we have a slide on that we ought to put up now for people listening to this to see, because you have a slide that shows 2.3 trillion outstanding and then 80 billion of potential distressed debt. So it's, it's 3% or something.
Yeah, and so it's what, obviously, again, I know you well know this, for those who are listening, it's like, a lot of people don't realize that CMBS and debt funds are just a tiny percentage of multifamily for the reasons we just talked about, because Fannie and Freddie are just so big. So, and you just, the delinquency rates for the Fannie and Freddie stuff is still, I think, like 0.4 something percent.
Yeah. So we just did earnings, and so this is a public number, but we have 7 defaults in our 63 or $4 billion at-risk multifamily portfolio. It's 10 basis points right now for us as it relates to defaults in our portfolio. So it's, to your point, it is not. Look, we don't like defaults, but the bottom line is, relatively speaking, it's a very small number.
Yeah, and we've seen lenders have generally been able to work with borrowers on figuring things out. And it seems like every time there is a foreclosure situation, it's always something else. Like there's some sticky situation that we had the San Francisco one where there was a rent strike and the city backed it. Another one in Texas, there was a fraud story behind it. It's always something else. And so I think generally what we see is that people believe in the long-term story, so therefore you're kind of willing to work through the current issues we have related to short-term floating rate debt. There's going to be some mess that still hasn't been worked out there. And so I don't want to totally downplay distress, but it's just not going to be fingers crossed, everything else. It's probably not going to be the massive shock that some people think we're going to see in the market.
So one of the things that you did point out, though, on a recent podcast that I listened to was, I believe in their Q3 earnings call, New York Community Bank talked about a massive step up in their multifamily default rate. And what you tied that back to was the inability to push rents up to market when a rent control unit comes vacant in New York, and that inability to push rents up to market has had a massive impact on some of the properties in New York. Talk for a second, Jay, about sort of that if you will, many housing advocates would sit there and say, oh, we want to maintain affordability and therefore that rent shouldn't be able to be stepped up. And at the same time, it's having a pretty significant impact on some New York lenders.
Yeah. So for those of you who don't know, like in 2019, there's a big change in New York law, which basically installed vacancy control to rent stabilized apartments. That's something like half the New York City rental stock is under some form of rent stabilization or rent control. And so with vacancy control, now they can't reset rents to market once somebody moves out. So the problem was almost overnight that devalued these properties by something like 30, 40%. And so some cases now the property is worth less than the loan. And so it had been considered, very safe loans for these rent stabilized apartments. I mean, it's just, coupon clipping type stuff all of a sudden is high risk. And so, New York Community Bank and some others had very high exposure to New York's rent stabilized loan portfolio, and it's been a real drag on their entire bank, unfortunately. And so, it's a real unfortunate situation. And I think we're at a point right now where, one of the big stories I think in this next cycle is going to be the challenge of these older properties that you're being put in a situation where if you invest the capital to improve the property, you have to raise the rent, you risk the gentrifier label. If you don't, you kind of risk the absentee landlord label because these properties are getting so old and they can't, some of these units in New York are sitting vacant because they can't afford to bring them back to market. And so it's totally inefficient. And so sadly, some of these rent-controlled properties in places like New York, as well as Los Angeles and elsewhere, are becoming, I think, almost illiquid. I don't know it's tough to make a strong investment case for some of these properties aside from, kind of a charity case, unfortunately. Yeah.
You talk about older properties and the ability to push rents or not, as the case might be.
Yeah.
You have a slide here that we'll put up that shows this is just showing the supply issues we've talked about the most supply year to date since 1987, and then what's supposed to be delivered in Q4.
Yep.
And yet at the same time, Jay, last week you came out showing significant rent growth in undersupplied markets. And so you looked at Pittsburgh and you looked at some of the other Midwest markets that have had limited supply and therefore on renewals are able to push rents 5-7%. And then you went into kind of an analysis which showed that in those markets you've had, stable rents. You're able to get high renewals rates today. And then you look at the oversupplied markets and lo and behold, you're not being able to get that same type of rent growth.
Right.
Talk for a moment about your thought on those markets and whether, for instance, would you go put capital into Pittsburgh today because it's getting the best renewal growth in the country? Or are you looking, and is Madera looking at higher growth markets that today might not be getting the renewal growth that they once had, but have a better long-term outlook to them?
Yeah, that's a great question. Well, first and foremost, I think this topic is a great example of why there's so much noise around rental affordability right now. And I don't want to downplay it too much. There's obviously a shortage of affordable housing. But, affordability is such a bifurcated issue. And what we're seeing is in the investment grade, institutional grade rental housing market, affordability is becoming more of a tailwind than a headwind. And so the reason I say that is these markets without supply, to your point, we're still seeing rent growth. So that tells you it's about supply, not about affordability. Now, the second thing I would say is that when you look at some of these markets that are seeing a lot of renewal rent growth, you mentioned Pittsburgh, as you well know, Willy, the problem in these markets is it's just very difficult to get scale. And everybody needs, especially nowadays, talk about efficiency, everybody needs operational efficiency. You're trying to build, podding of properties for better management. It's extremely difficult to do that in a place like Pittsburgh or a lot of these other Midwest markets. I think there's a few, Columbus, Kansas City, Indianapolis, we're seeing those maybe emerging as exceptions. I think we'll see more institutional interest in those markets. But it's tough. And so in terms of what we're doing at Madera, and I think a lot of others, is we're more interested in kind of the long-term story of some of these sunbelt markets that, particularly the ones that are larger, more economically diversified, have great demand tailwinds and aren't going away. But we know at this point we're going to have significantly less supply over the next few years. Like those are markets, and we could generate scale in. Those are the markets that are particularly attractive to us.
So you have a slide that talks about sunbelt versus coastal.
Yeah.
And then I'm going to, in a moment, have you talk about the difference between coastal city and coastal suburbs. But let's talk about sunbelt growth versus coastal growth. And this slide very clearly shows that Sunbelt growth and rent growth has been better than the coastal growth.
Yes.
Talk for a moment about that, sort of the disparity in these two. And the graph looks like it kind of tracks closely, but there's some very significant points where they sort of decouple. Talk about that analysis that you've done.
All right. So first, I'll tell you a funny story. So if you go back to the early 2010s period, I remember I was sitting in the office. I was invited to speak at one of the major life insurance companies in New York City. And I was making the case for, hey, like, I think we're seeing signs. Look at these demand numbers, early rent numbers. I think we're seeing signs that these bigger Sunbelt markets are going to outperform the coastal markets. But I've been wrong about plenty of things, but I'm going to pat myself on the back for this one. And they looked at me like I was crazy, because at that time, the view was, hey, the coastal cities are the safest places to be, coming out of the great financial crisis and everything else. But I think what we really saw through the great financial crisis and after that was really these larger Sunbelt cities kind of graduating past the awkward teenage years and becoming more mature, stable markets, particularly the bigger ones, places like, Dallas. And I know Denver, where we are now, is not technically Sunbelt, but I'm going to generously lump in some of the mountains because they behave pretty similar. And so I think, sure enough, what we ended up seeing is that throughout that entire decade, people always talk about supply, particularly, some of the Wall Street guys, supply. Well, the supply numbers until recently were just never that big. They were leading the country in terms of total units, but relative to demand, the numbers just weren't that big. The demand story was too big. It was outpacing supply. And so what happened is throughout that period, we saw the better Sunbelt markets outperform on rents relative to these coastal markets. And a lot of that just because it's not just about supply, it's about supply and demand. And the demand story was just that good. More recently, it's finally flipped. It's like the broken clock that's right twice a day. Now we're at that point where there's so much supply that these coastal markets are outperforming. But the way we look at it at Madera, the way I look at it personally, and our partners at Madera have a very similar view as mine, is that if you just, supply is the easiest thing to forecast. We don't know what's going on in the economy. We talk about rates and all this other stuff, but we know supply. It just starts to push forward a couple of years, right? Supply is going down. And so then you think about, okay, the demand story, barring some type of shock, what could change the overall trajectory of the major Sunbelt markets? Well, the affordability advantage is still there. It's still, the rents are about 50% cheaper in these major Sunbelt markets relative to the major coastal cities for the most part. So, the jobs, the regulatory environment, it's still, these are these are factors that change over the course of decades, not years. So we still feel really good about that. And so I think as we see supply start to come back down, these markets are going to be outperformers again.
So now talk about coastal and coastal suburbs versus coastal metros. One of the things I thought was interesting was when you were talking through renewal growth, actually some of the California markets, other than LA, have actually got pretty good renewal rate step-ups. Again, undersupply of those markets. But one of the things you pointed out recently was that the tech companies calling people back into the office may be driving a little bit of the step up in renewal rates in markets like San Francisco. But dive in for a second, Jay, on coastal suburbs versus coastal metros and the growth you're seeing there.
Yeah, so as we're kind of getting to, I think the Midwest is well positioned. I think the big Sunbelt markets can be well positioned, some of the smaller ones. And I think the third category, as you're alluding to, is these coastal suburbs. And, I got to give credit to, I think Avalon Bay really kind of pioneered this strategy, really focused on that. Because if you think about the whole investment thesis around the coast, it's really based on high barriers to entry, NIMBYism. And the reality is that cities, they generally want housing. They want apartments. And so it takes a ton of money, it takes a lot of time, but a lot of capital in these last couple of cycles and more than willing to take the time and the capital to do that. It may take you a lot longer than it does in the Sunbelt, but you still do it. And so we see high supply pressures in the institutional submarkets of places like Los Angeles and Seattle, parts of DC, et cetera. What really stands out, though, is in those suburbs of these big coastal markets, particularly suburban Boston, east side of Seattle, parts of the Bay Area, and even parts of Southern California. Certainly, parts of particularly Northern Virginia. You get to some of these places where it's really difficult to get land and to build. You have NIMBYism. People show up in the city council meeting and say no more apartment towers in our backyard.
Right.
They don't want any of that stuff. And so that's where the real barriers to entry really are. And yet you still can have great demographics, great affordability stories. And so you have all those factors, but you're truly insulated on the supply side. And then the other thing I'd put out there too is that I think that, the smarter investors are looking for those suburban cities that have, I'm trying to think of the right terminology here, that have relatively sane city councils. Red or blue doesn't matter, but you have to have a predictable operating environment. I tell people, I have this conversation sometimes with some of the Yes in My Backyard, the YIMBY movement, and try to tell them, hey, look, if you really are serious about building more housing, it's not just about creating an environment to build more, but it's also you think about you have to operate there too. You can't say, hey, we want to build more and say we're going to incentivize investors to build and then demonize you once you actually operate it, right? And so you have to be part of a city that wants to have more collaborative relationship with builders and operators where you can, create compromise and win-win situations together. And so I think we're able to see, cities and suburbs that are willing to have those kind of productive relationships. So I think we see in a lot of these suburban places, it's not as hostile to apartment owners. Those spots I think could be very well positioned over the next couple of cycles.
It's really interesting you talk about consistency. I think when I talk to our clients, or when I'm asked by investors in Walker & Dunlop, is a 450 10-year problematic? And I'm like, 450 10-year isn't problematic as an actual coupon rate. It's that one moment it's 375, the next minute it's 450, then it's 425, and it's this inconsistency in where rates are that makes it so it's impossible for our clients to either establish a cap rate that makes sense or establish a financing cost that makes sense to them. And therefore, from 2022 into 2023, as rates were going up, extremely fast at 75 basis points per Fed meeting, people they couldn't transact. Their cap rate didn't make sense. And it's just interesting to me, Jay, that you're talking about, city councils, whether it's blue or red, forget about that. It's just a consistency of outlook that allows developers to say, I like this, I don't like this. And I find it to be really incredible that there are plenty of city councils across the country that aren't sort of getting that memo. Yeah. Again, either side of the aisle that say, oh, we're going to, and I think one of the other things about it that is an interesting backlay for the next, or backdrop to the next 4 years, is that of all the things either good or bad about President Trump, the one thing we clearly know as far as his behavior is that he's not terribly consistent. He kind of moves from one place to the next. I think that's a fair thing to say. Yeah. And so as a result of that, it will be very interesting. I mean, the Wall Street Journal came out today and talked about the need for a Treasury Secretary. It essentially was saying all these other nominations that you have, whether it's in the energy department or whether it's here or there, not that, but the capital markets need stability. They need a steady hand on the tiller, if you will. Yes. And that they were trying to basically say to President Trump, please put someone in that job who will give us a steady outlook on the capital markets. And it is amazing to me that, that's what we're looking for. Yeah. Is some sort of forward plan that says that if I put a shovel in the ground here 3 years from now or 2 years from now, when that delivers, I'm not going to be facing a completely different either local, state, or national economic situation. Absolutely.
Real estate at the end of the day is local, right? And so, you look at the tragedy of St. Paul, Minnesota. One election cycle can completely torpedo the entire pro formas of every investment in a city. And so I tell people all the time, it's would you rather do a policy risk or supply risk? And if you choose policy risk, I think you're crazy. Yeah. Because policy risk is unpredictable and almost permanent. Supply risk is predictable and usually temporary. And so I think that's a big, I think a lot of investors have historically, my personal opinion here, I think historically have underplayed policy risk. I think now it's changing, right? especially through the COVID era, it's changed. But you need that stability. You need to be able to know what what the environment is. And by the way, again, red or blue, whatever the rules are, you just need to know what the rules are going to be. And then you can sort of adjust to make that work or not work. But you have to know where the playing field, you can't change the game, change the rules in the middle of the game. That just makes it a really tough environment.
For those people who are listening and don't know what happened in St. Paul, just for a second, talk about what happened in St. Paul and then what happened in Minneapolis at the same time.
Yeah. So what happened in St. Paul is there was a ballot initiative that was, almost literally written on the back of a napkin. I mean, it was hey, 3% rent cap straight, no exceptions, unless you want to petition the city to, plead your case that you need more than 3% for some really extreme reason. And so I remember being at an NMHC event where I'd never heard about this until the local apartment association folks showed up at the NMHC fall meeting, and they said, "Hey, this is what's going on. We really need your help." And at this point, I think it was September.
Yeah.
The election was in November, and everyone's like, "Really? Like that's kind of crazy." And sure enough, it passes because it sounded good on the ballot. No one really understood the unintended consequences of it. And so what happened is St. Paul. This was, I think, to 2021. I think they completely took them. You look at starts and permits just completely evaporate. Right. You look at the greater MSA. You take Minneapolis. You take the suburbs. Just like the rest of the country, starts and permits accelerate. St. Paul does the opposite. So they completely took themselves out of the biggest building boom in a generation,
right,
which is the ultimate, way to really drive affordability and availability for renters. And so it was a real tragedy. And they've tried to kind of unwind some of that. The mayor has done a little bit to try to do that, but it's unfortunately still been a very challenging environment. So, there's nobody wants to build there right now.
Right. And it's been a boom for Minneapolis.
Yeah.
And as a result, I mean, there couldn't be. It would be like going to Fort Worth, Texas, and Dallas, and saying, okay, let's pass Fort Worth and Dallas, and one freezes it and the other one doesn't. And just watch what happens. And obviously, that ain't happening in Texas.
But the Federal Reserve Bank of Minneapolis wrote a paper about showing that this process the economists call filtering has actually happened in Minneapolis. So they built so many apartments, and actually even they built a lot of smaller rental homes as well. That small apartments that it led to downward pressure on inflation for the entire part of that market.
Right. So let's talk about trickle down a little bit here, because you just published last week something on rents in C assets, and so there's a sense people a lot of people, particularly my age, who were around when Ronald Reagan was president of the United States, trickle-down economics was something that a lot of people are like, no, trickle-down doesn't really work. Yeah. But actually what we're seeing in apartment supply is significant trickle-down from you build a lot of high-end, and then it goes down to the Bs, and then it goes down to the Cs. Right. And let's put up this graph on where we are on rent reductions in C-class apartment buildings, and lo and behold, the greatest savings to C-class renters are happening in those markets where, newsflash, you've had big supply at the top of the spectrum on A-class, which has gone down to B and gone down to C. Talk about that for a second.
Yeah, first of all, whenever I post about this on social media, I try to avoid trickle down just because it triggers people in the wrong way.
Yeah, totally.
It gets
totally. And I'm sorry for bringing it up, but the moment I saw that, Jay, I'm like, that's trickle down happening in the sense of you start up here and it works its way through the system.
No, you're totally right. But yeah, it'd be that terminology sets people up into the wrong way because just because of the word, but it's true. That's what's happened. So, nationally, when you look at Class C apartments, they're still relatively steady, solid rent growth, but there's a real split when you look at these higher supplied markets, which I'm thinking you have on this list. And the biggest rent cuts happening in places like Austin are building like crazy are actually in Class C. So here's what's happening. When you build a new apartment building, just because of construction economics, is typically Class A plus, as you know. And so they're pulling higher income renters out of your A minus, B plus. They're cutting rents and pulling people who are your higher income B minus, C plus renters. They're moving up market. And then on the C side, here's what people don't understand about Class C. The people look at it and say, hey, well, they have the most affordable rents, flight to affordability, et cetera. Well, it's not quite that simple. The problem is that when you lose your better quality tenants, and I say quality in terms of income level, affordability, you lose those people to move ups because all of a sudden they can rent something nicer, newer, better located at a similar or slightly higher rent. They have to cut their rents the most. And the reason for that is that they now they can't just go to the next level down. They have to get to people who couldn't previously afford any kind of market rate rental. They were looking for some type of subsidized, LIHTC, Section 8. And so now they're in a position where they have to cut rents substantially. And that's what's happening. And so the whole idea of filtering or the trickle down concept is that you pull up higher income people out of the more affordable housing and open up units to those who really need it. That's exactly what's happening in these higher supplied areas. So you build luxury apartments, it has a direct impact on lower income households. And now on the flip side, we'll tell you to investors, I think it puts a real question mark on the long-term trajectory of Class C in some of these spots because it's going to be harder to push rents in with those dynamics.
Yeah. And if you look at this list that we had up, I mean, the big markets like number 2, Austin, number 5, Phoenix, number 8, Salt Lake. Yep. Those are the markets where everyone wants to be at the high end. And at the same time, those are the ones that have gotten the biggest price concessions on C-class, which is just, it's fascinating. Talk for a moment. You have a slide, Jay, that we ought to put up here that just talks about the demand at the high end. So you have it broken down on the various income levels, and where you're seeing the most growth in the renter base is actually at the high end. Talk about this slide for a second and what we're seeing there as it relates to real demand growth at the high end of the market.
Yeah, so this is a great chart actually put together by the Harvard Joint Center for Housing folks team using some census data. And it really dispels a common myth, which is, one of the things I hear all the time. I talk to people outside of the industry. They think people are renting because they can't afford to buy and they're all lower income. And they don't understand is that, it's not just some industry data. This is public government data showing that the vast majority of renter household formation over this last decade has actually been people households making $75,000 and above. And that's what explains all this demand for Class A product that we've seen over the last, really 10, 15 years. And so I think this goes into a little more depth what we talked about earlier is there's the greatest untold story in rental housing is the bifurcation of affordability. And by that, what I mean is that there's been incredibly ample demand at the top end of the market for what we'd call institutional investment grade apartments and SFR. At the same time, we have a significant number of people who cannot afford any type of market rate apartments or SFR. And by the way, the vast majority couldn't afford it even prior to the inflationary run up after COVID. And so it's like two things that are true. We have a shortage of affordable housing, and we have a ton of demand for investment grade Class A, Class B apartments. And so, and there's, I think, a ton of data points around this as well. It's one reason why we see rent income levels are so much lower in institutional and REIT grade apartments and SFR relative to kind of census data you see where it says half of people are spending more than 30% of income on rent. Well, very few people living in investment grade market rate housing are spending more than 30% of income on rent.
Yeah, you bring up that stat, which is it's actually interesting. You posted on it last week about the fact that in 2012 or 2013, the average American was spending 30.8% of their gross income on rent. And in 2024, it's 31%. So it's up by 20 basis points between 2012 and 2024. And just there's this narrative out there that the rent burden has gone up dramatically. And plenty of people on Capitol Hill sit there and talk about how housing is unaffordable. And look, in the campaign, it was this consistent mantra of housing is now unaffordable. One of the things I said a number of times was that there was this big, there was the narrative that inflationary pressures in housing have gone up tremendously and therefore people can't buy their single family home. You can flip that and say that 65% of Americans actually own their home and 80% of those people have a fixed rate mortgage. And therefore their most valuable asset actually is appreciated by over 50% on average over the last 3 years. And like the Democrats never turned that back around to say, there actually is a flip side to this. This is actually quite good. All they wanted to talk about was housing affordability. But talk about that number, Jay, as it relates to we're looking at a very similar dynamic as it relates to how much income is going to rent today in 2012 versus 2024.
But one other point on just real quickly on the campaigns is like, I'm obviously not a political strategist, but I think there was a real political win for the Democrats to say, look, like there's many apartments and rental homes got built and look what it did to rents. But instead they never embraced that message of downward pressure on rents as a relative supply. Instead it was, other stuff. Right. And so, it's been that ratio of income spent on rent really hasn't changed in more than a decade. But again, what has changed is there's a growing number of people who cannot afford market rate unit. At the same time, there's a growing number of people who we have 1 million more market rate apartmenters today than we had prior to COVID. And they're generally spending 22, 23% of income on rent. And so it's both things that are true. And I think one of the problems of the narrative today is that it's not targeted enough. And a lot of times we're focusing on the wrong parts of the market. Like everybody wants to blame institutions, private equity, Wall Street, but that's not really where the problems are. You look at it's really having to do with a shortage and an underfunding of affordable housing, people who aren't actually living in institutional investment grade apartments and SFR. So, everybody wants a boogeyman, but it's just, that's not, again, I mean, the data is pretty clear. That's not where the problems are.
Yeah, there's one other slide that you have that we'll put up here, which is just talking about income growth versus the cost burden for rental housing. And the one thing that I would point out on this slide, Jay, is that this is market rate.
Yes.
And so it's not across the spectrum, because you and I have just been talking about the cost burden being at 31%, and this is dropping down to the 20s. And that's basically due to the data that you're pulling from the REITs. You're pulling from SFR, and then this is all market rate, not more broadly on affordable and high end. This is market rate.
Right.
But on this slide, it's very clearly showing that the cost burden on rent and rents being flat recently, and where incomes have gone, actually the rent burden is coming down in market rate.
Yeah. Yeah. In fact, this has been a big theme across apartment owners everywhere. I mean, another thing that Avalon Bay talked about in their earnings call was that rent income ratios, I mean, they're, I think, the largest by market cap apartment REIT, their rent income ratios have been coming down. And everyone's seeing the same trend. I mean, incomes are growing faster than rents because of supply. Again, I think we're 21 straight months where incomes have risen faster than new lease rents. I think it's going to continue. We're going to erase the entirety of the hump that was created in 2021, early 22, when rents are growing faster than incomes. And that's a great story. I think it's a great tailwind for the multifamily and SFR investment thesis. Again, like, it's important to kind of point out, hey, we still have a problem on this side of the market. There's a lack of affordable housing. I'm a big fan of, expanding LIHTC, among other things. I think we need to do some real things there.
Which you don't think is going to happen given where tax rates are going to go and given the House and the Senate controlled by the Republicans?
I like to remind people, Reagan is the one who signed LIHTC into legislation, right? And so this should be.
Yeah, but Richard Nixon created the EPA as well. So we got to understand that sometimes where things are founded doesn't necessarily mean that their party sticks with them for a long period of time.
Right. Well, what I want to make the case though is that the low-income housing tax credit should be the ultimate compromise, because it solves a progressive concern using a conservative philosophy, which is incentivize, carrot and stick, the private sector to solve the problem, right? And it's a voluntary program. It incentivizes the investors and developers to solve the problem. The problem is it's too much red tape. It's too complicated. It's not funded enough. All those things need to be solved for. Now, I will say, to President Trump's credit, in the first administration, they put a lot of focus in the opportunity zones. There's great data showing that led to significant supply in some of those areas. But I do think that I don't know if they're going to propose this or not, but we should. I do want to see LIHTC expansion proposed.
Yeah, I mean, look, to that, you can't disregard opportunity zones and what that's done. Yes. And what it did from a supply standpoint. You also can't disregard the fact that during the first Trump administration, Calabria made a change to Fannie and Freddie to allow them to aggregate capital and build up a balance sheet rather than passing all that capital through the Treasury, which now actually positions them to actually be able to be spun if that's something they want to do. Had they not been able to keep that capital on their balance sheet, Fannie's balance sheet now is between $80 and $90 billion. Back when they had a $10 billion balance sheet, there was absolutely no thought that you could get them spun because you would have to raise so much capital to do it. So I think it's very interesting that there are a lot of people who sit there and sort of throw tomatoes at what Trump did as it relates to housing in the first administration. And those two things very clearly were wildly positive to the housing.
Well, I'll give you one more thing. This is something I actually forgot about this until recently. I was doing my research during the election, is that a lot of they go back to the YIMBY crowd, the SMI backyard. A lot of them forgot that Trump actually started a task force on removing regulatory barriers to affordable housing. But the problem is he started very late in his term, and so never went anywhere. Unfortunately, the Biden administration did not maintain it. But I hope he brings that back, because that's another real game changer potentially.
And COVID stepped in, and I think one of the big things that we all have to keep in mind is like some of these anti-eviction laws that are in place, and the House actually has a bill that's up right now to try and limit the use of some of the COVID era anti-eviction laws to make it so that landlords can actually get control of their properties again. Yes. But I do think that I think people sometimes forget all that COVID brought about as it relates to, forbearance on all Fannie and Freddie and HUD insured loans and a number of other things that came out. Those are fortunately gone now, but it did turn the world on its head for a certain period of time. And we're still in some areas trying to play catch up to getting back to the economy and housing policies prior to COVID.
Yeah, you're 100% right. And you mentioned the eviction moratorium. I think what's I think been really unfortunate about that is that even 4 years later, in a lot of cities, they still treat it like there's an emergency. Well, emergency means you didn't plan for it correctly. Right. Cities need to be planning for these things. And I think one thing I'd like to see cities do is better differentiate between fraud and real need. And I think you talk to almost any apartment owner, and they'll tell you is, look, if someone's struggling to get by and pay the rent, they want to work with them. They'll come with a payment program. The issue are the fraud issues that have really exploded since COVID. People it's stolen identities. People aren't who they say they are. You have somebody with a shared wall leasing next to somebody who doesn't know they've even who they are, who they're really. Like, there's a real risks there. And it still takes, in some cases, 6, 12 plus months to handle that situation. So I wish that cities could really focus on identifying fraud and separating it from true need. And I think you'd see more of a collaborative approach between the industry and the government if we can do that. You mentioned the sort of the boogeyman of private equity firms is easy to throw darts at. And clearly Elizabeth Warren in the last election cycle loved to both, and Sherrod Brown for that matter, love to sort of throw the blame at housing unaffordability at some of the big private equity firms that have gone out and bought single family housing. Yes. You published recently on a paper that was written by Josh Coben at NYU that basically debunks all of that as it relates to the cost of housing going up due to private equity firms coming in and buying a huge amount of the single family housing supply. Jump on that for a second. Yeah. So, Josh's paper really just piggybacked on a lot of other research. A lot of people don't realize this, but there's been ample research. In fact, there was a paper written a couple of years ago by somebody from HUD. It was about the declining homeownership rate in Atlanta, and didn't mention the fact that homeownership rate had actually gone up in this whole paper. But it was talking about institutional investors buying up all these homes and not mentioning that homeownership went up over the same period of time. That's dishonest. And so a lot of homeownership has been trending up since 2016. It may go down a little bit this year because of all the issues with buying, but it's been going up. And so anyway, his paper really showed, number one, that when investors came into markets like Atlanta and Phoenix, et cetera, it actually put downward pressure on SFR rents. And so rents rose less than they would have otherwise if these homes had not been purchased. Number two, he also pointed out that that the impact to home prices was actually much less significant than people thought. I mean, there is, anytime you buy a house and you take it out of the for sale pool into the rental pool, there's obviously an impact. But he made the point that because of one thing that every headline misses, they talk about investor purchases. They always ignore investor dispositions, right, the sales, and they sell a lot. Right. That got completely. In fact, Invitation and American Homes for Rent are on the individual home side, they're selling more than they buy because they're all doing build to rent stuff now. So mom and pops are selling more than they're buying. So we actually added more homeowners than we added for sale homes over the last 8-10 years in our country. That's why we have a real problem. So anyway, it was a great paper, and it kind of debunks a lot of those. And one of the other things you pointed out, Jay, in your write-up on it was the fact that from 2010 to 2015, it was those institutions that were stepping in to provide liquidity to the market and actually bail out a lot of the mom and pop homeowners and bought a lot. Yeah. And then from 15 to 21, it was very difficult for the institutions to play because they'd provided the liquidity, and then people who were better capitalized at that point were stepping back in and actually buying the homes. And so it was very counterintuitive to the extent that these legislators are kind of throwing darts at the big private equity firms who actually played a huge role between 10 and 15 providing liquidity, and then were basically priced out of the market between 15 and 21. Yeah, I asked Dallas Tanner of Invitation Homes about this recently. I was kind of joking with him. I said, hey, you went from like the hero in the early 2010s. Now you're the boogeyman everyone's trying to blame. But you're right. I mean, a lot of them shifted because of even not just the political stuff, but I mean, a lot of the homes got to a point, the pricing, an individual home buyer is usually willing to pay more than an investor because they're buying it as a home, not as an investment. An investor's looking for, an asset that really nobody else wants at a great discount. A lot of times it needs a lot of capital improvement work that the individual home buyer can't pay for. They're looking for that. And so you look at the big institutional guys, as they've all really shifted to new construction, to build to rent. They see more efficiencies of scale. It's easier to one big check versus a lot of smaller checks. Like there's a lot of reasons why that shifted. I mean, they own less than 1% of single-family homes in America. They own less than, I think, 3 or 4% of SFR homes in America. It's still a mom and pop market. And ironically enough, Senator Brown just lost re-election after he opposed that legislation. Not cause and effect, but that's probably not going to go anywhere, at least for the next 4 years. Interestingly, I understand that he actually may run again in 2 years because
J.D. Vance's seat is now open. And so while many people thought that was the end of Sherrod Brown, he actually has a chance to run again in 2 years. And so he might try and get back in on a non-presidential year. He probably plays a lot better than he does on a presidential year.
And just for those who don't know, like just to have people know, like his proposed legislation would have put, I think, a 5% rent cap on anybody who owns 50 plus SFR homes and created basically a tax disincentive to own these homes. And so ironically enough, I mean, it's kind of like the tariff conversation. This would have put upward pressure on SFR rents.
Yeah.
Because all of a sudden, anybody owns 50 plus, they have incredible market power, and then there's some more demand than supply. So it wouldn't have done what's intended purpose.
I will only say this. I was with Senator Tim Scott, who's the incoming chair of the banking committee last week, and I was incredibly impressed with Tim Scott's knowledge of the housing markets and the overall banking system. And he was speaking to the real estate roundtable, and he was just as impressive as anyone I've ever heard. And in the one Senate Banking Committee hearing that Sherrod Brown held on housing when he was chairman of the Banking Committee, you get through everyone having their 5 minutes, and the chair has as much time to talk about anything that the chair would like. And Sherrod Brown jumps into asset condition at 2 assets in the state of Ohio. And I'm sitting here going, we're supposed to be at 30,000 feet on like real housing policy that's going to move our country forward. And Chairman Brown decides to raise issue with the HUD secretary and the head of FHFA about 2 assets in his home state. And it's just like, you're just trying to go back and say, hey, I held this issue up at the hearing. It's like, let's stay on the real issues that are important to housing policy. Jay, we're now looking at an oversupplied market, but then again, we look forward to a very undersupplied market. So there's a graph that you have that we'll put up here that shows about how we've gone from the most oversupplied to a wildly undersupplied market. And we're right now looking at, 250,000 starts in 2024, which is just going to drop us from 600,000 this year right down. And so you sit there and you say, well, why aren't people building right now? Why is it that this data says to you it's a great time to be putting a shovel in the ground? And so you went and looked, and one of the interesting ones that I thought that I saw was the American Association of Architects, that you went and looked into there, and just them being hired to go build multifamily buildings is like at some all-time low, which I thought was a fascinating way to look at it. You talked about banks and banks being still with underwriting standards that are very, very tight. You talked about the fact that the economics just don't work. There's a great graph that you showed that said that on a recent survey, 92% of developers basically said the numbers just don't work for me to put a shovel in the ground. Right. Should people look beyond all that and just say go because of this lack of supply that's coming up in 26 and 27, which, as you said previously, if you're going to bet on regulation or bet on supply is a really easy one for you to go bet on. Yeah.
Well, I mean, honestly, I don't think it's a bad bet. I think you see some of the REITs are willing to do that. I think a couple of problems is, number one, is that the traditional way is not going to work. The debt is there, but it's way too expensive. And so you have to have another way to make it work. If you have the cash or you have a lower cost of capital like the REITs, that helps. If you have a property tax abatement, like in certain states have, like in Texas, we're trying to do some PFC, HFC type deals like that. That makes a lot, especially if a high property tax state, that makes a big difference. But there's only so much of that's going to happen. But the other factor too is like, I talked to a lot of different people in the industry just at ULI a while back, and the problem is everybody's telling this story. Every developer in America is telling this story. Every GP is talking about this story. Hey, low supply, it's building, it's low supply. The problem is like, I think a lot of the LPs out there still look at it as like, okay, it's cheaper in their minds to buy versus build. There's a more immediate return of capital. So why do I want to go build if I can buy? Now, whether or not you can actually do that is a whole different question, right? But I think it's challenging. You talk to a lot of developers. It's still challenging to raise capital around the development strategy. And the other thing I think is really hard too, is people don't talk about enough, is that we're still seeing heavy lease-up concessions. Not just concessions, but actually base rent cuts as well on lease ups. That makes your target pro forma rent for your for a new project very difficult to pin down. At the same time, you have high costs, and so all of that stuff, I think, I think it's going to. My personal opinion is, I think it's going to take until these lease ups stabilize. You kind of figure out what the rents are going to, those Class A rents are going to stick at, and then that's still. I mean, that's a year out. So the best case scenario, you're into delivering a couple of years, so late 27, 28 for even have some pickup, and even then I think it's going to be fairly moderate. It took a perfect storm to get to 1 million units under construction, cheap debt, cap rate compression between asset classes, COVID era inflation on rents plus this peak demand. Like we're not going to have all those factors back together again. And so I think even when it rebounds, it's probably going to look more like 2018, 2019 than it will look like 22, 23, 24.
So what's that mean for valuations? Because that clearly you're going to be in a supply constrained market.
Yep.
And particularly in some of these high growth markets where people, I mean, you mentioned Avalon Bay building in Austin, but I mean, Austin is that one market right now of high growth that has almost 9% new supply coming onto the market. And so Austin has been tough this year. But even there, Avalon Bay building and people saying, hey, this is a great long-term growth market. I'll go into it. But what does that look like in your mind for 26 and 27 as it relates to national rent growth? I mean, are we at 3% national rent growth? Are we at 5% national rent growth? What's it mean in such an undersupplied market?
Well, I think there's sort of two answers here, right? There's what you want to put on paper, and there's kind of what you think is the upside scenario, right? And for us, it's like I think I think you can feel safe for the 3 to 4% assumption, but I think you look at it, you think, you know what? There's real upside. This can be. I don't think it's going to be COVID era peak double digits, but I think you can make a strong case it'll be 5-7% range in those years. Again, I don't know if you want to assume it in your underwriting, but I think that the upside is there if we continue to see demand like we're seeing.
And so then, and obviously rates are going to have a lot to do with this, Jay, but what would you then project as it relates to cap rates and cap rate compression? You talking in that kind of an environment, 25 basis points, you talking 50 basis points, you talking 100 basis points?
Well, honestly, I've been surprised when it's already come down. I mean, you go back to like the rates conversation. I think the first rate cuts were already kind of priced into where properties were trading because they knew they'd eventually see some rate cuts from the Fed. But I mean, we talked about, we're looking at how much lower can they go until we see real, movement in the 10-year. But no, I think you're going to see so much capital that's still chasing these newer vintage, well-located, Class A recent construction. I mean, everybody wants it. Everyone wants these same things. There's a great quote from the CEO of BSR REIT, Dan Oberstein. He said something like, the gazelle that we're chasing are Class A lease-ups in the big sunbelt markets. Everybody's chasing the same gazelle. And so I think, because you believe in that long-term story, I mean, I think we could very easily see those numbers go even a little bit lower.
So what's the red herring? What's the thing that happens here that could make it so this outlook, which is from reading everything you've been publishing, is very positive on multifamily housing over the next 3 to 5 years. What's the curveball that the market isn't thinking about right now?
Well, I mean, there's a few things, right? I mean, number one is any kind of recession risk. Obviously, we still need economic growth, and recessions like the thief in the night, they're hard to predict, but they eventually hit. Obviously, if we do see something like all of these tariffs go through, that's going to put more pressure on construction even more, which could then put upward pressure on rents, even inflationary environment that could create more challenges. That could resurface a lot of these regulatory risks in other parts of the country that don't currently have them. And so, but I think long term, I think the biggest structural risk to rental housing is regulatory risk. And
given the recent election, you think there's a period here where that tones down? I mean, in other words, had Harris won, I'm assuming as it relates to that being a real risk would have stayed higher in your mind. With Trump winning, that comes down a little. Or do you think that given so much of this is at the local level, that there might actually be a counterweight to a national Trump win that could actually get local regulation stepping up to try and offset what Trump's going to try and do at a national level?
Honestly, I think both of them are talking about removing regulatory barriers and all those kind of things. But as you know, it's hard to actually move the needle at the city level. Harris talked about building 3 million units above baseline. Right. That wasn't going to happen. Trump's not going to be able to do that either. It's tough to really have that big of an impact. I think the bigger thing goes back to conversation about the agencies. And I think the biggest, they're so important to the health of this sector. I think what we probably see is at least for the next 4 years, is there's reduced risk of further politicalization of the GSEs. But that can certainly change again. I mean, if we start to put strings attached to agency debt, that's going to make everything more expensive, and start to push borrowers elsewhere. And that can have a real impact on the market.
Yeah, I am constantly amazed at the fact that a lot of people on the inflation and the health of the U.S. consumer throughout kind of post-pandemic through the last great tightening, a lot of people discounted or didn't think about the fact that our secondary mortgage market is the envy of the world. Mm-hmm. And the fact that 80% of U.S. homeowners have a fixed rate mortgage under 5% allowed them to continue to go out to Target and Home Depot and continue to buy.
Yeah.
Whereas if you were in Japan or the UK, you typically have a shorter term floating rate mortgage from your bank. And as a result of that, as rates spiked, your purchasing power went down significantly. And so one of the main reasons our GDP growth continued to grow throughout that period, well in excess of our large other developed countries, is because of the secondary mortgage market. And so to your point, underscoring the importance of Fannie and Freddie to the overall health of our economy and our overall banking system is just...
Oh, yeah. And on the rental housing side as well, I was talking to David Rickman recently, formerly of Freddie Mac, and he's told me he's writing a paper. I hope I'm not stealing his thunder here. He's writing a paper about the success story of U.S. multifamily and how it should be a model for the rest of the world. I mean, like, people don't realize outside, even our industry, like how unique the U.S. apartment property is, right? Like, this is a very unique concept. We're starting to build more in Europe and stuff like this. It's kind of being copied, but it's a very unique American concept. And he said part of the success story is the presence of the agencies, the debt structure we offer here, and then the lack of rent regulation. Like, those factors have allowed us to build a lot more and then put, ultimately, unfortunately, everything's still gotten more expensive, a more healthy rental market than much of the rest of the developed world.
Yeah. Final question for you. As you look out and say, okay, I got to pick sort of, and I'm going to keep you out of pinpointing exactly where you'd put it. But if you sat there and said, we're going to either build or buy, it's either going to be workforce or high end, and it's going to be either coastal gateway or sunbelt. Run me through where today Jay is saying we're putting our dollars.
All right. So if we're making anybody upset, like, first of all, I want to say it's like, I think you can be successful anywhere, right? I mean, you and I both seen that enough, right?
That's great.
With the right strategy, the right person, the right location, you can be successful anywhere.
But you're looking at a lot of macro data. And so as the macro data says to you, if you're going all in on something, I got a roulette table in front of you and you got to put all your chips on one strategy. What is it?
So in terms of what I want to do, what our team at Madera wants to do, is we're really bullish on the larger Sunbelt markets. We love the demand story. Supply story is going down. Texas, Carolinas, Nashville, parts of, Atlanta suburbs, a little bit of Florida potentially. I think those markets are still going to see the great demand story is going to be there. You have lower regulatory risk. You're going to have lesser supply going forward. And then in terms of, I think, because of the issues we mentioned earlier, I think that it's going to be more Class A and B plus, where you have, a healthier financial dynamics among your tenant base. You've got newer vintage requiring less CapEx work. And then on the construction side, I think both can work. I hate to kind of hedge, but I think if you have the right location where there's not been a lot of newer supply at the top of the market, especially in some of these good quality suburbs, I would be less urban in certain markets, but I think you can build good stuff in some of these suburban locations. And then on the workforce side, if you can build at that kind of middle market rents where you're, B plus, A minus, and you're competing with properties that are 10, 15 years older, but newer construction, I think that's a great strategy too. So that's what I'd be chasing. And we will be chasing.
You will be chasing. Jay, it's a real pleasure. I'm super thankful of you coming into our offices to do this live. It's been great. Your data is fantastic. You've got 95,000 followers on LinkedIn, which is an incredible number of people who follow your research. And I'm quite certain that when we publish this out on YouTube, there will be many, many, many people who watch it. I was actually just looked at Ryan Marshall, who I had on last week, CEO of Pulte. He had matched in his first 5 days. He'd matched General David Petraeus, who was on the Walker Webcast about a month ago. And I wrote Ryan today and said, you're doing really well catching up to David Petraeus in only 5 days. But thank you very much. It's been a real pleasure.
Well, thank you for having me.
It's great.